Hi, this is Rob Beardsley with Lone Star Capital, and today I wanted to share a really fascinating idea, which is the 4 quadrants of investing. So I didn't come up with this. This is from a really good book, the Investing in Real Estate Private Equity by Sean Cook. Actually, it's a pseudonym for someone who wanted to keep their name private. But anyway, so the 4 quadrants breaks down like this, and I'll do it inverted so you can kind of visualize it more clearly. So the top 2 quadrants, we have good outcomes, and the bottom 2 we have bad outcomes. And then to the right we have consensus, meaning the market thinks it's a good idea, and then we have non-consensus to the left, which is not a good idea. Generally speaking, the market doesn't think that. So it's really interesting to break down each individual quadrant and what those look like. So let's start with kind of the top right. And so the top right is good outcome but consensus. And so what that means is you made an investment that is in line with market expectations. You bought into a market that is growing. The market knows this. It's priced appropriately for that growth. And so in the end, you have a good outcome, but it's muted by the fact that you paid consensus value. So you're only going to hit a double, let's just say. So outcome, as we call it. And so not a bad thing, and nobody's going to really question you for doing it because it was a consensus investment. Now let's go to the other side of the equation, which is good outcome but non-consensus. And this is really fascinating because this is a home run. This is where you took a contrarian bet against the market and you won, and this is where you get a huge payoff. Because you got in on a contrarian bet, you paid very low pricing for it, and since value add likely materialized and you got cap rate compression because you bought it when the market thought it was a bad idea, and now you're likely selling it when the market has come to realize it's a good idea. And so these contrarian bets are where you make the best return on your investment. But now let's go to the bad outcomes, and let's stick on the non-consensus. So if you make a non-consensus investment and it ends up being a bad outcome, well, your downside is muted because it was non-consensus. You didn't pay high pricing for the opportunity. So hopefully, the way that you financed the acquisition and your basis was low enough to support taking that non-consensus risk. But in the end, those risks materialize, but hopefully they didn't wipe you out completely, or you're still able to record a modest return. So, but the downside of this as a manager is, looking back, you're going to look foolish, right? You made that non-consensus bet and you ended up being wrong. The market was right, as it often is. And so this is very risky as a manager because you're really putting yourself out there on the non-consensus side. And now let's go to this quadrant, which is it's a consensus bet and a bad outcome. And this is the worst quadrant of all. And it's really interesting. When the market bet something and it gets it wrong really badly, right? Because when the market has a consensus, prices are high, everybody's piling in, it becomes a crowded space, and then what ends up happening is the bad outcome wipes people out. All those high prices that people paid, now they're paying the price. They likely were aggressive with their debt and their assumptions, and they're obviously the prices they paid, and so they weren't able to mitigate losses. So that quadrant is really risky. So now that I've broken down the 4 quadrants, let's just kind of touch on the high level. So it's interesting to look at consensus bets. Your range of outcomes are so-so, kind of like a double, a decent return, to the worst outcome, right? And then on the non-consensus side, your range of outcomes is a home run on the upside, and then hopefully a so-so downside outcome where you don't get wiped out completely. So I'm not advocating for any one quadrant, as obviously we want good outcomes, but in terms of consensus versus non-consensus, I'm not advocating for one or the other. Obviously every deal matters, what price you pay and the specifics of it, but just wanted to share this concept of, just because the market thinks it's a good deal doesn't mean it will be, and just because you're making a contrarian bet doesn't mean that you're the genius and everyone else is wrong and you're bound to get the home run. Thanks for watching.